Nicholas Bornoz of Capital Link, welcoming you to the first panel of the forum. This is a tremendous topic, dry bulk shipping. I'd like to thank Randy Giveans from Jefferies, who is going to moderate the panel. And of course, I'd like to thank our great panelists, Hamish, Polis, Ulrik, Martyn, and Stamatis. And I'm going to turn off my camera. I'd like to point out exactly how the online version allows us now to connect major industry participants from all over the world to share their insight. We have people in Athens, in New York, in Cyprus, in Norway, in Singapore. I think I said Athens, so this is really great to be with you. Randy, you can take over. And again, thank you to everybody.
Awesome. Hey, thanks for that introduction, Nicholas. Always a pleasure to be a part of the Capital Link Forum. This dry bulk panel certainly will be a hot topic. So let's get into it. My name is Randy Giveans, Head of Energy Maritime Shipping Equity Research at Jefferies. Today's panel, we have 5 of the top executives in a very hot sector, and that's dry bulk shipping. So I'll do a quick introduction, and then we'll get into some questions. Hamish Norton, President of Star Bulk Carriers. Martyn Wade, CEO of Grindrod Shipping. Stamatis Tsantanis, CEO of Seanergy Maritime Holdings. Polis Hajioannou, CEO of Safe Bulkers, and Ulrik Andersen, CEO of Golden Ocean Group. So lots to discuss. I have a list of questions here, so we'll try to run through these, and maybe we'll have some time for Q&A at the end. So feel free to submit some of those questions to those watching. Starting it off, there's certainly some people listening who maybe haven't looked at dry bulk in a while, certainly not dry bulk experts. So we're going to try to change that over the course of the next 50 minutes. The market's experienced some very impressive results over the last really 2 years, and the industry remains very bullish, in at least my humble opinion, one of the hottest sectors for at least the next few years. So with that, if we can just do a quick overview of what has really led to these strong rates over the past several quarters. Hamish, largest, most diversified fleet, I'll give you the honors to start us off.
Okay, so basically, what has led to the strong rates? First of all, there's sort of a global synchronized demand recovery from COVID-19 across all major cargoes and routes. We have record high inefficiencies, which essentially reduce the supply of ships. So it's COVID lockdowns, sanctions, all this basically increases the waiting time at ports. And also a big impact, effectively reducing the supply of ships, is high bunker prices. And, that's something that intuitively you'd think would hurt, but actually it helps a lot because everybody individually tries to maximize their profit, and you maximize your profit with high bunker prices by slowing your ship down and burning less fuel. And, that reduces the supply of ships. So, that the high bunker prices we're experiencing now are probably one of the strongest, influences causing the dry bulk market to be higher. And with that, why don't I let others address the question?
Yeah, and we can get into some more specifics first. And maybe Martyn, you can shed some light here. One unique thing about the recent rally or the strong market is how it's unique from previous ones, where it's really been led by the smaller asset classes, right? Even today, a Supermax, even a Handysize, is outperforming a Capesize. So what is different in the current cycle that's maybe causing these smaller asset classes to outperform the Capes?
Well, if we look at the Handysize, that was written off a number of years ago as there was no future for them, everything will get larger and larger, which is all well and good if you trade to the 8 or 10 large ports in the world, but with 300-400 ports in the world, the Handys were always going to be in demand, and especially with what's happened now with as Hamish said, the recovery. So basically zero fleet growth. In fact, at times last year was negative, continuing this year. And then obviously high bunker prices, but you overlay that with the red hot container market. And what's happened, of course, is that with container rates so high and people having to sail on certain schedules, everything that once upon a time was bulk that went into containers has come back out again. So we're seeing an awful lot of break bulk now, bag cargoes, other cargoes, coal, scrap. People might find it hard to move grain, but millions of tons of these commodities go in containers every year because the container rates have been so cheap. This is now moving back in. So we are being really underpinned. And those of us that are fortunate to have box-hold ships, we're finding that we're able to carry a reasonable number of containers and we're getting some unbelievable rates. I mean, when I look at what my team are fixing, and we fixed one out the other day for 60 days at $50,000 a day on a 33. I mean, you pinch yourself. It is really, really hot out there. And that container market, yeah, it's not letting up anytime soon. So it's a combination, right time, right place. Supers, ultras, kind of similar again, but it really is the handys that are really the superstars that we're finding on this market. And I'm sorry about Hamish and Ulrik and others that, we're earning about 3-4 times their capes, but hey, it's our turn this time, yeah?
Yeah, Ulrik, you got a response to that?
Yes, I think I'd like to arrest that notion that the smaller segments outperform the cape sizes. Yes, at this very moment they are, but we are also at a low season of iron ore demand and production, so the comparison is not completely fair. And if you want to put things a bit in perspective, then last year, 2021, the average cape size rates were 6,500 per day higher than the super index. And since 2019, it's been more than $5,000 per day every day. So yes, right now there are some factors that are impacting positively the smaller segments. And look, we are happy about that. We want a stronger, floor that would benefit us later. So we are happy about this, and might I also add that we have 40% of our cape size, of our fleet is Panamaxes, so they are certainly benefiting at that at this current situation as well. But I think we need a more nuanced discussion than just saying, okay, the smaller segments are outperforming. That is not how it has been over time, not even in recent time. And then I think as an investor, of course, there are other considerations that you need to put into this as well. What is the cash break even of the fleet? What is the average age of the fleet? How is the fuel consumption? How much intake do you have on your vessels? So for instance, how many Newcastlemax and Kamsarmaxes do you have? How much can you deduct of value out of the market? So there are many considerations here, and as I say, I just want to try and debate the notion that the smaller segments are outperforming. I think the world is a bit more, nuanced than that.
Okay. And while I have you, Ulrik, if you can touch briefly on Russia-Ukraine, right? That's certainly been a topic we're getting questioned on a lot from investors. The impacts there to the dry bulk flows, anything that specifically you've seen on the Golden Ocean fleet or other kind of anecdotal evidence of any disruptions there?
Yeah, needless to say, now I do it anyways. We are deeply concerned about the humanitarian crisis that is unfolding and naturally condemn the actions that are happening in Ukraine. And we hope the conflict ceases as soon as possible so we can have free flow of cargoes again and of course peace in Europe. So with that said, then inherently us as our fleet composition, we are not as exposed to the conflict. When the conflict broke out, we had 2 of our 92 vessels in the area. They are now out. So generally speaking, we haven't felt the direct consequences so much. Back to your question, if you look at how will this impact the market, then we think it will have different impacts for different segments, and also depending on how long the conflict is. I don't want to talk now for 15 minutes, but if we just cut to the chase, we'll say that a shorter conflict is probably likely to be good for shipping, whereas a longer conflict is probably more likely to be a bit negative. None of them massively negative or massively positive. I think for just to put a few more comments on, you have two kind of main cargo groups here. You have coal, which is definitely going to be allocated more inefficiently because the Russian coal can now no longer go to Europe, meaning that has to come from as far away as Australia we have seen. And that is likely to be able to adapt to a prolonged conflict, whereas the grains, which is quite a large chunk of seaborne grains coming out of Ukraine and Russia, is, well, in the short term, probably replaceable from other destinations. But over time, we think that there will be a demand destruction. But I'm sure that, so again, we are not so exposed to the grains trade. I'm sure that Martyn and then some others will have a better view on that, or maybe a different view even. But generally speaking, as I said initially, we hope this to be resolved quickly. But the consequences of this conflict for Golden Ocean, given our fleet compositions, are not insurmountable by any means.
Stamatis, if we can turn over to you, touching on the major bulk. Firstly, coal, since we've already discussed it a little bit. Very important in the world's energy mix. I think news this morning that China was going to increase their coal power generation for the next few years. Obviously, inventories remain pretty low. How big of an opportunity does that coal trade have for 2022, 2023, especially with the elevated natural gas prices and the disruption in the coal trade flows?
Well, first of all, it's a great opportunity because coal a few years ago was not even on the radar screen of the Capesize transportation. We did only like 5% of that. Right now, that has increased to about 30 or even more %. And to Ulrik's point before, Russia is exporting 50 million tons of coal to Europe annually. And that has to come from longer distances. And the Capesize segment is going to benefit substantially on that. We see the re-emergence of coal. The problem with coal is that years and years and years of underinvestment in the coal mines has led to coal shortages. So now the big charters are trying to make the catch-up game, and they're trying to export as much coal as they can. Unfortunately, BHP, Rio Tinto, Glencore, you know, they didn't invest as much as needed because coal, I remind you, a few years ago was dead fuel to most of the market. And right now it's re-emerging again. So it's a great opportunity. It's going to require some additional investment in the coal mines to see that catching up with the demand, but certainly we'll see a lot of coal flows into Europe and other places in the world that require a ton of energy. So that's our take.
Okay. And then, Paulus, to you, on the other side of the major bulks, iron ore. What's your outlook for the iron ore trade 2022 beyond? If you can shed some light on, you know, Chinese property markets, iron ore inventory levels, possible stimulus spending, and then obviously, of course, the Vale operations.
Yes, I'm not the expert on the iron ore. Stamatis maybe takes this question, who is a Capesize guy. He tell us more details into that. I generally believe that iron ore will be stable. This is the information I have. We don't carry that much of iron ore. We are all coal and grains and other stuff on the Kamsarmaxes and on the Panamaxes. And but I believe from what I have researched on iron ore and what I'm hearing, it's more like a steady year, irrespective of if stocks are up or down. But maybe one of the Cape guys can give us more input on the iron ore sector.
Yeah, I think. Sorry.
As Stamatis said, we have 5 or 6 Capes. We see more coal on those than in previous years. We see more coal on those in previous years.
Hamish, iron ore?
Yeah, so on iron ore, we actually have a pretty positive outlook for the next 3 years. You know, first of all, China had in the past stated that it was intending to basically reduce its output of CO2 associated with steel production in 2025. That would be the peak year for CO2 production from steel. And now they've moved that plan to 2030, you know, which is basically another 8 years, therefore, of steel production growth, as far as we can tell. And, you know, Brazil, you know, looks like it's going to be producing more iron ore. And we think all of that will be taken up by the market. you know, and you know, we see strong demand for steel exports from China, as you know, EU obviously is going to try to limit steel imports from Russia. So, you know, all that we think is going to contribute to demand for iron ore.
If I may add here to Hamish's point, Brazil has been lagging significantly. They have been exporting the lowest amount of iron ore of the last 10 years. If that says something, they have exported less iron ore than the years that they did the Brumadinho mine, just to give you an idea. In order to catch up Brazil and meet their targets, they need to double their exporting levels on a daily basis. And that's why, to Ulrik's point before, we strongly believe that Capes are going to catch up significantly on the rest of the market because, again, it's very simple. It's simple maths. In order to meet the 320 million tons a year out of Brazil, as well as the other 50 or 60 from the minor producers, we will need to see Brazil exporting double the quantity starting from Q2 onwards. And that means that the Capesize should be catching up or even exceeding the other sectors, because there's going to be huge volumes coming out of Brazil, which is the longest ton mile between Brazil and China.
Sure. Martyn, we'll switch gears to minor bulks. What's your outlook for the grain trade and other minor bulks?
Continues to be very positive. Obviously, grain has been very, very steady. And it's interesting, you look at US outstanding grain sales through to later this year. It's a lot of grain. It's almost rivaling the amount last year. So there's a lot of demand. And then you look at what's happening, you know, Ukraine was large exporter, Russia number 5. You've got a lot of countries, especially those on the doorstep, that are now missing grain. There's a real scramble going on for the commodity, which, like a lot of other commodities, means ton sea miles, get it from where you can. Obviously, longer term, if you remove those two countries, it's an interesting one. Then the world really has to kind of rethink what it wants to do. But at the moment, I'd say there's serious talk about China having massive weather problems for its crop this year and being very short. So I think it'll probably go to the highest bidder. But you look at certain African countries that get 100% of their grain from Ukraine and places. People have to get it from somewhere else. It's positive. Steel industry, as we just talked about, I mean, obviously, Chinese steel production slowed very dramatically last year. It's now very pleasing that its latest figures, it's 14% up on the low in November. That seems to be recovering. The housing industry, there's more stimulus going in. And also steel production, excluding China, the rest of the world, it's still continuing to be very positive. And if America starts with any of the infrastructure, then it's going to be incredibly positive, which will also be, you know, ton sea miles long haul. So all in all, a very, very positive outlook, overlaid with, as we'll come to later, literally very, very few ships delivering, and next year, nothing delivering. So yeah, so this could be multi-year. It's very positive.
Yep, our thoughts exactly. Polis, how impactful, could increased infrastructure spending in the US and elsewhere be to the dry bulk market?
Yes, if the infrastructure projects of the US go according to the announcements, this will be very, very good for the dry bulk sector, especially the smaller sectors, which in turn will imply better market also for the bigger ships. Because in my 35 years in shipping, I always remember that smaller ships were eating cargoes when the market was improving from the bigger ones, like we were losing cargoes to Supras and to Handys, and the market could never recover, you know, out of when these sectors like the smaller vessels had not so good prospect. Now these sectors have very good prospects with what is happening on the container ships and the lack of new builds, especially on the Handys. They are fully occupied. And to the contrary, you know, I can tell you that a couple of months ago, we carried a couple of cargoes of Supras in post-Panamaxes at better rates that we were receiving in the spot market on the, especially backhaul cargoes on our post-Panamax at the time. So it shows that the story is reversing now, and the healthier are the smaller sectors, the longer will last the recovery of the dry bulk. And I'm very optimistic for the next 2 years at least, because the order book on all sectors of dry bulk is very small compared to the last 20 years average. For example, we have an order book of 6% across the board, with small differentiation between the sectors, whilst the last 20 years order book average on the dry bulk fleet was 21%. So we managed to survive with 21% and make small profits, even with the hands-on ship owners managed to make small profits. Okay, some other went out of business, but the long-term players stayed afloat. And with 21% order books on average, now with 6%, the people who know this business, they stand to make huge profits for the years to come. And I don't think that when the owners rush to invest their profits in new buildings, I don't think the yards would be willing and they would be keen to build dry bulk vessels, because they are the cheaper of the lot. They will go for added value vessels like LNGs, container ships, or other sectors like they are doing now, LPGs, or even tankers, which also tankers are under ordered at the moment. And I think dry bulk, we will struggle to find berths in the future for many dry bulk vessels, especially the small ones. So the guys who have handies, they should keep hold on those vessels. And those vessels also will support our market as well. So I'm very optimistic, at least for 2 years.
Okay. Staying on that ordering new builds, it's been a big topic of discussion and differing opinions on it. So, Polis, while we have you, if you can continue, you obviously decided to order some new buildings recently. So can you give some kind of color on that decision to order? And then Hamish, if you can counter that with deciding not to order recently. So Polis, we'll start with you.
Yes, 2 years ago, when we made the decision to invest in the new buildings, so we were believing that we would have a fast transition between the type of ships on the environmental front. So at the time, we found good low consumption vessels, the so-called phase 3, tier 3 new builds in Japan. We grabbed those at prices that they were very attractive, at levels that we haven't seen for 20 years. So we thought to invest there. Of course, now the things in front of us will delay the switch to the new energy and to the new fuels, with what is happening now with the sanctions of Russia and the power game and the energy game that is being developing. So I believe there would be a delay, which is good for our market. It's bad for the environment, of course, but it's good for our market that this will delay for a year or two. So I think that the timing of our investment was very good. We get delivery in May of our first of those new buildings, and another 8 vessels in the course of next 18 months. And we're very happy about the investment, because already the ships are worth 12 to 15 million more than the prices we paid on it. So there's a $100 million appreciation of value. Of course, it's not reflected in our stock price, but this is not for me to influence. But I think it was the right move for the right reason. But this right reason will not happen as soon as we were expecting. But still, it's a good investment for us.
Sure, Hamish.
Well, I mean, the reason we haven't ordered new buildings is basically that if you look at secondhand tonnage, a modern secondhand ship is a good bit cheaper than a new building. New buildings are really expensive right now, and your modern secondhand ship is in the market at a strong point in the market. We're very optimistic about the market for the next 2 or 3 years at least. But if you look at the forward market, the FFA market, when your new building would be delivered, which would be, probably early 2025 or, possibly right at the end of 2024, the FFA market is not high. So there's no, you can't hedge your new building in that FFA market. And, also the ship you order today is almost certainly not the ship you're going to want in 2030. Now, nobody really knows what ship you're going to want given the regulations that, will be there in 2030, which we don't really know for a fact yet, either what precise regulations will be there. But whatever, that the ship you order won't be the ship you want. And probably in 2 years, you can order a ship that you might want in 2030. So there's some reason to wait. But, frankly, we think that an older ship that has less life past 2030 is probably a better financial investment right now,
Yep.
given the regulations that are going to be in place.
Yes, Stamatis, I was going to turn that to you as well. Kind of your thoughts around new buildings versus modern secondhands versus older secondhands. I know a lot of your vessels are 2009, 10, 11, 12 built. What are your thoughts on those three kind of tiers of tonnage?
Well, in hindsight, I think the deals that Safe Bulkers did in the new buildings are great deals. And I think that these ships, especially coming out of from Japan, will have much longer value than the 2030 cutoff point. Now, I think the opportunity is pretty much gone. The price appreciation of the new building has gone to levels where it makes it completely uneconomical, knowing what the future rate is going to be, like Hamish said. So I don't think it makes any economic sense. But moving back to the point as to whether the FFA should denominate, decisions to build ships or not, they should not. And I think that, if we had more clarity about what the vessel of tomorrow would look like, then obviously, people would make a more educated decision. Right now, I don't think we have all the right aspects, the right, data in front of us to make a decision about putting new buildings at mid-high $60 million on the Capesize alone from our side.
Yep. Martyn, staying on the order book to fleet ratio is 6.5% or so. What is kind of preventing it from going to 10 to 15 to 20? Or does that happen once we get some clarity around propulsion regulations?
I think that's very important, propulsion. I think as all of us sitting here as experienced ship owners, the thing we've learned over the years is you don't want to be the first of anything. You sit on your hands, you watch and wait and see. Go back just before I started the business in the early 70s with gas turbines, and we all what if you remember back that far, what happened to those owners. And I think it's still very, very, the jury's out. I mean, is it LNG? Is it ammonia? There's a whole load of questions, and also human nature, man, it is very, very ingenious. And I suspect the rules will change. So yes, obviously what Polish did, brilliant. We also, took a couple of delivery in 2019 and a couple of ships that delivered on period in 2020. We now have purchase options on and eye-watering. But you actually want ships on the market now, as Hamish rightly says, you want them on the water now earning. So to be going forward, we are in a business with the lemmings, and they always say that that the end of a good market is when an owner builds their way out of it. But at the moment, there's no sign of it happening. And I think absolutely right. I mean, yard capacity is a lot less from the heady times of 10, 11 years ago. And yards, I mean, if you're talking now, in our case, an Ultramax pushing towards 40 million in Japan for delivery 2 years from now, doesn't make any sense. It's secondhand is where the value is. And then we'll probably come on to it. Secondhand prices have a long way to go. They are very much undervalued basis today's earnings. So, yeah, I think we've all been in the business too long. Never say never. And everyone's got short memories. But at the moment, I think that there is no sign. And if they do, it's years before the idiots can destroy the market.
Sure. And Ulrik, one thing that's been kind of underappreciated by some is a lot of focus on new buildings or lack thereof in a good way. But the order book being so low. The other side of the equation, you have a lot of vessels already over 20 years of age. many more aging into that kind of 20-year threshold in the coming years. So how do you view scrapping in the next few years? Clearly, with rates being where they are today, not much scrapping is going to happen. However, as Hamish mentioned earlier, fuel prices are very high, steel prices are very high. So there are some incentives, at least, to scrap, especially ahead of IMO 2023 and beyond. So what are you seeing for scrapping this year, next year?
I think the story of dry bulk is about reasonable demand growth and exceptionally low fleet growth, coupled with inefficiencies from coal allocation, coupled with inefficiencies from COVID, coupled with inefficiencies from IMO 2023 regulations, which perhaps we'll touch upon more later. I don't see this as a scrapping story. There will be some scrapping for sure, there always is, but strong rates will make this limited. So for me, scrapping is a non-issue really. I don't think it's where this, because what would be the driver of the market?
Sure. All right.
If I may add here for a moment, I agree generally with Ulrik in what he said. Also, let us not forget that all the decoupling that happened in 2018 and 19 for the ballast water treatment system means that a lot of ships, or all the remaining ships, will need to install ballast water treatment system, and that's a very expensive and timely and time-consuming exercise, especially in China. So you will have all the older assets that escape, the 2018 to 20 first installation wave, all of them installing ballast water treatment system, which is a very heavy investment on its own. Second to that, the new environmental regulations that I'm pretty sure that we'll discuss later on today, a lot of ships will become uneconomical and not being able to compete. So let's have all that in the back of our minds, because from 2023 onwards, it's not going to be the same landscape for all the ships out there in comparison. That's my take.
Yeah, no, I can just follow up quickly on that. Yes, so I'm talking from a market perspective. I don't think scrapping would be an issue, but it is absolutely true that for those that do not have a modern fleet, Golden Ocean has the youngest fleet among the listed owners. For them, there will be a lot of capex here that you have to keep thinking about as an investor, that you'd have to throw into upgrading your vessels to comply with IMO 2023, potentially reducing the top speed or the capture speed of your engine, ballast water treatment systems, etc., etc. Obviously, these costs will come out of the cash flow, so that's negative. But we can be sure that these vessels will, for the most part, unless they are really, really old, be able to find trades in which they can be employed. And if the cape rates are going as we believe they are, Panamax for that matter, and all the other classes, then there will not be so much scrapping. But that doesn't mean it's going to be cheap for the owners to keep them on the water. It will probably just still make sense to do it. So that was my point.
Sure. All right, let's drill a little deeper into the IMO regulations there. Obviously, a lot of talk around what the IMO is going to do next. Now, we already know, starting in 2023, ramping up into 2030 and obviously 2050. But for the current fleet, how will it comply? What are you maybe specifically doing to prepare? Hamish, start us off.
Well, so basically the single most powerful thing you can do to reduce the fuel consumption of a ship is to go slower. Sure. Because a ship basically burns fuel in rough proportion to the cube of the speed. So you go a little bit slower, you burn a lot less fuel. So that's a big thing. For most of our ships, so-called engine power limitation gets us into the carbon intensity indicator and EEXI regimes, no problem. For some of our other ships, we're putting on energy saving devices, which are, MEVIS ducts, which you can look up on Wikipedia, or fancy anti-fouling paints, or hull cleaning robots, or ultrasonic anti-fouling. Basically, besides going slower, the thing that really hurts you is hull fouling. So addressing hull fouling is probably the second most important thing you can do. We're spending a lot of time and attention on that.
Okay. And then Stamatis, back to you. Any thoughts on the winning fuel 5 years from now? Is it LNG? Is it ammonia? Is it methanol, hydrogen, something else?
Surely, I don't want to take a bet on that. I mean, we don't know what that is going to look like in the future, and that's the list of the points today that I would like to take a guess. Going back to energy-saving devices, we are doing installations on all of our ships to make them more competitive from now until 2030. We have done it either in cooperation with the charters or on our own, and we have made advanced modeling with proven solutions to reduce by anywhere between 12 and 15%, which is quite significant. But as for the fuel of tomorrow, I certainly don't want to take any wild guesses here.
Okay. All right, let's focus on capital allocation, asset values, operations, congestion. So I'm gonna ask each of you kind of one question on a variety of topics here. So starting with you, Martyn, a number of you on the panel and most of the dry bulk industry at this point have recently updated their capital allocation programs or policies, either paying out dividends or share buybacks or a combination. Star Bulk, along with Genco, were among the first to update and change their capital allocation policies. So why was this an attractive route to go? I know many of you, your share prices are at multi-year highs, so one would argue it seems to be working. Martyn, I know you recently started a new capital allocation program. Can you give some kind of color on that?
I think you've got to reward long-suffering shareholders, and obviously at the moment we're printing money. So we introduced our policy, 30%. It is conservative. As we showed in the last quarter, we were actually, despite doing share buybacks, we still maintain what we paid in Q3. And I think owners are in a very fortunate position, but you always got to remember that you've got to reduce debt down to a degree in a good market and put yourself with a bulletproof balance sheet going forward. But as the cash mounts up, I mean, this year, Q1 is already, incredibly, insanely profitable. So we're well ahead of last year, and you look at what's happening in Q2. So I think it'll be adapted as we go along. But very much so, you've got to reward the shareholders, great dividend yield, and but also with an eye on keep the cash in the bank. We've also got a number of purchase options, which some of them in dollars, some of them in yen. Of course, with the way the yen is these days to the dollar, these are dirt cheap. And we have some older ships. Although it was interesting, was Polis made the comment, don't get rid of your handys. And yes, that's always the issue. We have some older handys, but boy, they're cash cows. But it's a great position to be in. So rewarding shareholders, but having the flexibility. My CFO, Steve, as you know well, always said, in the past, it was always wondering where the money's coming from. Now it's a matter of what we do with the money. It's a great position to be in. And as usual, on a market like this, you don't want to blow it going forward. And I think to be flexible, rewarding shareholders, but with one idea, we all know shipping, things do happen. But it's very exciting.
Okay. Polis, you mentioned kind of a strengthening secondhand asset values and looking forward. Obviously, very strong supply-demand dynamics. Steel prices remain at elevated levels. And you're saying, and I probably agree, that asset values are still undervalued. So how does that impact your secondhand acquisition versus sale strategy?
Look, if we find an opportunity on a second-hand vessel, we may purchase one of those. If one sector is not performing well, temporarily, you may find an opportunity left and right. But there are not many opportunities in second-hand. Generally speaking, you see 5-year-old Kamsarmax is asking 40 million or trying to sell for 40 million. So for us, we are not going to buy on those prices. So we have to continue the deleverage in any form, whether this is via loans or other means. And at the right time, buy the odd ship we may find there. Recently, we start giving a dividend back to shareholders, but at the same time, we have an order book to take delivery. We want to take delivery of that order book with a minimal debt added on for those ships, maybe with very little debt. And we keep going like that. And as I said, I believe in a very strong market. And if I may be allowed to make one more comment on the previous topic of scrapping, I don't expect any increase on scrapping for 22 and 23. Will stay very, very low, the scrapping. But the scrapping, I believe, when the market corrects, will be the safety valve for the dry bulk market for many years to come. So there's a lot of ships to be scrapped and go out of business. If the market corrects in 25 or 26, there will be many ships to go out of the market. That will ensure maybe the market not at $35,000 or $30,000, but at $20,000 could be sustainable for the rest of the decade. And this is very good news for all dry bulk owners.
Yeah,
Sure.
I should just quickly point out that, you know, you don't have to scrap to shrink the fleet if everybody slows down in order to decarbonize. That's a very powerful effect.
Get that cubed route going. That's fair.
Yes, one part of the fleet will slow down definitely with the new regulations. Some part will scrap because some charterers won't be there to fix those ships. So there is an age limitation. I mean, people, they don't want to carry, and you have to remember we're getting into a phase of expensive commodities, and people don't want to even coal now is an expensive commodity. People don't want to put high value cargoes into vessels that are over 20 years old. So this will be also in the game.
Ulrik, my question for you is about leverage and debt, right? This is kind of a new question that the industry's really had to answer in recent years. Just a few years ago, it was survival. Who cares about our leverage ratios, right? Whereas now, it's what is the ideal leverage ratio? Some want to go zero debt. Some want to go net debt zero. Some think 30% is a good threshold. What do you say?
Yeah, I'll focus on Golden Ocean. We believe that a certain amount of debt is makes sense, but certainly when you go into the high cycle, which we're going into now, you'd want to be below 50 in our view, which we are. So we maintain that leverage going into the cycle, and it means that we have, what can you say, some leeway to go as and when the market turns, as it inevitably will at some point. So when you couple that with a solid balance sheet on the cash side, we believe that you stand at a strong place, which then allows, and it's going a bit back to Martyn, but it ties together to the capital allocation strategy, of course, which means that when you have your house in order, you can also, with good conscience, pay out a lot of dividends. Certainly, when you see the prices have gone as they have gone, it's too expensive now, or certainly, maybe there's more upside, but we feel it's too expensive to buy into that, and that means that the excess capacity then can be plowed back to the shareholders. And I mean, if we look at last year, we paid $500 million in dividends on a market cap around $2.5 billion. We bought 18 vessels on water in February last year. We contracted further 7 vessels in the middle of the year, Kamsarmaxes, for delivery in early 2023. So you can say we kind of made our play. We have bolstered the balance sheet with cash and with low debt, and now we are ready to go into this yield phase where we reward the shareholders. So we, to answer shortly, we believe we are at a good place with around 45-48% leverage.
Got it. Thank you. All right, we only have a few minutes left, so I'll ask a few more questions here. Interesting dynamic in a strong market is the decision to lock in time charters versus continuing to play the spot market. Stamatis, my question for you, most of your fleet, if not all, is on some kind of contract, either some fixed rate or index linked. How do you view this dynamic in the current market?
Well, in our opinion, this is the best way to go. We still believe that the market has tremendous upside, and the index linked charters that we have gives us the best flexibility. I mean, first of all, the ships are employed at all times. We do not bother with bunker prices or bunker, to get bunkers on board the ships or anything like that. We get a great premium on the scrubbers that we have installed. And at the same time, we maintain this flexibility in order to fix the ships from floating to fixed. So we have this embedded option that we can basically move from floating to fixed for certain periods. And that has proven to be very, very good, very profitable for our shareholders. So for us, that's the way forward. We will continue this kind of index-linked transactions. And when we see rates above 30,000 or more on the Capes, then we might be locking in some additional fixed rate on the ships. That's the plan.
Yeah. All right, Hamish, my question for you is about scrubbers. Wouldn't be a shipping panel without the word scrubbers, and discussing it briefly. Clearly, fuel spreads have soared in recent week. Fuel prices very high for VLSFO, HSFO, not as high, clearly. So you're locking in some pretty nice premiums here. Can you elaborate on what those levels are for Capesize versus Panamax versus Supermax?
Sure. Well, of course, all of the ship types are getting pretty much the same spread on a per ton basis, which is between it's between $190 and $200 a ton right now. We're basically getting the full spread between high sulfur and low sulfur fuel. So it's really just a question of how much fuel the ships burn. And that's sort of very dependent on the routes, but on an annual basis, we burn about 800,000 tons of fuel with our fleet. So you can kind of multiply 800,000 tons by the spread between high sulfur and low sulfur fuel, and that's what it's adding. It's order of it's over 100 million a year. It could be as high as 150.
On a dollar per day basis, 4,000 to 8,000, depending on vessel?
Well, it depends. Yeah, I mean, on a Cape that's burning 50 tons a day, while it is burning 50 tons a day, right? Sure. I mean, we're saving like $10,000 a day. Of course, it's not always burning fuel. It's at port a good bit of the time, but it's a big effect.
Okay. Martyn, but one more question, and then we'll get briefly to the lightning round. So, Martyn, my last question for you. Clearly, there's been a lot of consolidation or maybe privatization in the LNG sector, some in container ships, a little bit in tankers in recent years. Not a ton, per se, in dry bulk, although there have been some privates being bought via ships for shares, what have you. What are your thoughts on consolidation in the dry bulk industry?
Yeah, it's in some ways it's almost inevitable, but then again, it's the cultural fit, the fleets. Obviously, we're sitting there. It is quite a topic of conversation on the markets, with us having 20 basically brand new Handys, Ultras. No one else out there's got them. There are people that obviously look at us the whole time, consolidation, and we're the fleet upgrade a lot of people want. But like anything, I mean, we've been around 50 years. We've got existing operating business relationships in Japan. Is it necessary? I mean, Hamish they're the big boys with a $3 billion market cap. It's fantastic. We're pushing towards 500, which is great. But like anything in shipping, it's also, you've got to have one eye on if and when things change. It's not if, sorry, sounds my CFO. When things change eventually, and it will in the years to come, you've also got to be the right size. So it's interesting. Consolidation for the sake of consolidation, no. But culturally, if the fleets work and you can make it work, then very much so. If it's wrong, you can probably destroy brands as well. But I think there are possibilities as we go forward on this market. Yeah, very much so.
Fair. All right, we have 3 minutes left, so I'll do 3 lightning round questions. 1-word answer is all we need. So, Stamatis, starting with you, dry bulk ton-mile demand growth in 2022.
Well, our opinion is about 5%. That's where we see the growth.
Okay. Ulrik?
Let's say more than supply growth for sure for the next, and that's for the next coming years. And that was more than 1 word.
It was, but okay. Paulus?
For ton miles?
Ton-mile demand growth, percentage terms.
Should be 6-7%, I think.
Wow. Okay. Hamish?
I'm with Ulrik. It's more than the fleet growth, but it's enough more that it's going to be helpful.
Okay. Well, the next question is fleet growth, but all right. Martyn, give me a percentage for demand growth.
Between 4 and 5%.
Okay. And then supply growth. Lightning round question 2. Supply growth this year.
This year, 2.5% absolute tops.
Okay. Certainly less next year, but for this year, Stamatis?
On a net basis, we believe supply is going to grow less than 1 to 1.2%.
Wow. Okay. Ulrik, supply growth?
I'll repeat my answer from before that. Can you say the supply?
Paulus?
2% on net basis.
Yep.
Yeah.
Hamish?
And I actually think it's going to be very small, like less than 2%, because basically the fleet is going to slow down. The high fuel prices are really good for shrinking the capacity of the fleet.
All right, last question. Fortunately, this is virtual, so Nicholas can't come and slap me to get me off the stage. But Martin Wade, give me an average rate for handy sizes for 2022. Spot rate, full year 2022.
Average for the year, looking where we've come from, between $25,000 and $30,000 a day.
Okay, Stamatis, Cape size, average rate, full year this year.
At least the same level as like last year, that was 31, at least.
Okay, Polis, Cape, Pana, you pick an asset class and give me a full year average rate.
A full year, so 25 for Kamsarmax, 30 for Capes.
Okay, Hamish?
I'm with Polis, 30 for Capes, 25 for Kamsars, and handies maybe are going to be through the roof. Who knows?
Wow, through the roof. All right, Ulrik, last word.
Yes, Cape sizes, repeat of last year, around low 30s, but remember, of course, Golden Ocean, and I think also some of the other owners, we have Newcastle actually a scrub upside, etc., etc. So the reality is that we will harvest more from that. But from a Baltic perspective, around low 30s, and I'm mirroring now. I didn't get who said that around 25, maybe a bit higher on the Panamaxes.
Okay, perfect. Thank you again, gentlemen. Nicholas, thanks. Sorry for going over a few minutes. Dry bulk's an exciting time, so thanks for giving us a few extra moments to share.
Well, thank you
Thanks,
very
Rob.
much. Tremendous panel as expected. I mean, look at the attendance. Thank you very much to everybody. Thank you.
Thank you, everyone.
Thanks, Nick.
Bye-bye.